Jay, I'll start off with you because what the markets seem to be telegraphing, at least today, is that there will be trouble ahead for the economy in terms of what we're seeing in the move in the Treasury market. There will be trouble ahead for banks, according to what we're seeing in terms of the banking sector stocks today. And there's a flight to safety going on because the tech trade is still on fire. I mean, is that the right message that we should be taking away from the Fed?
Well, I think that what the Fed is going to be doing here is, and, Jay Powell's been saying this consistently, is they're probably going to be on hold for a long period of time. They want to see inflation come back down towards their 2% target, and we're still a long way from that. So they may stop raising rates here in May, but it's not like I think they're going to be cutting rates come the third quarter.
Steve, I'm curious, how has the expectations for pivot settled out in Fed funds futures since the meeting yesterday? And I asked you that because, he pretty much said, I don't see that in the cards this year, but I'm just wondering if markets are actually accepting that as truth.
Okay, so it depends on your definition of pivot. Is a pivot a pause or is a pivot a cut?
No,
because a cut. Okay, so if we have that Fed rate outlook chart in the back, and I'll just take a look at it while folks are looking at it at home, there is a strong expectation. There's the January 24 one. And so what is that? Wow, it's really down. It keeps falling. Powell says no cut, and markets price in more cut. That's where we're at right now. It was at 540 a couple days ago, and then it was 513 this morning, and then I just opened this up again. It's 408. So do the math. The peak funds rate, at least in the futures market, is 491. So there is, call it 90, call it 85 basis points of cut built into the market. And I can tell you when that begins. I mean, it looks like the first full quarter point cut would be built in, by August or so. So that's where we're at right now, which is sort of like, and another thing that's happened, Melissa, is the gap, which is the same thing. The Fed is at 513. The market's at 408, so you do the math right there. It's more than a full percentage point of gap between the Fed and the market. And I was just looking back at this, Melissa, when the gap changed in February. You remember we went down from it was at 75 basis points, and then it went down, and the market got in sync with the Fed for the year end. You know what happened to the S&P in February? It went down 5%. So that filling of that gap, or the closing of that gap, can be painful for stocks.
Oh, definitely. And that's why I asked the question. I mean, what the markets seem to be telegraphing, Jay, is that they are expecting, unlike at least what the Fed is telegraphing at this point, something to really break so hard that the Fed will need to cut. And that's to me what that chart tells me. And I'm wondering how you see it play out, given a banking crisis unfolding, et cetera.
So there's a little bit of disconnect, I think, between the stock market and the bond market. If the Fed's going to be cutting that much by the end of the year, I think it's because you're in real economic trouble at that point. It's not necessarily a financial crisis, right? But you are in a recession right now. And I'm not a stock market strategist, but I guess the question I would have is, are stocks priced for a recession at this point? I look at the S&P 500. It's down maybe 20% from its peak? I mean, that doesn't seem like a recession sort of thing to me. So I think there's just a little bit of disconnect to what's going on. Either that or the market thinks that the Fed is going to blink, and as the first signs of trouble, they're going to start cutting. I'm not convinced of that. I think for them, the primary culprit that they're trying to deal with here is inflation, and they want to see that come back down.
Yeah. Steve, it looks like you want to jump in.
So, yeah, it's interesting to me. I mean, the question is, how do we get there, right? I think there's some expectation in the market now that the Fed comes down to where the market is, in part because of some of the realities that we're talking about, which is credit tightening in the economy. And that's okay if that's what you think. The trouble, sort of emphasizing what Jay was saying, is I don't think a credit tightening event is going to be good for the stock market. If indeed that's how we get to lower inflation. So I think it's not crazy. And I don't know, by the way, even though Powell said he doesn't think we're cutting this year, he also said that they're going to be guided by what happens with credit markets and how that impacts the economy. So I don't think it would be a huge about face for Powell and the Fed, in fact, to cut this year if, in fact, we do have a really and serious negative fallout from the credit tightening. I'm not sure, Melissa, that we're talking about that kind of big enough event for that to happen. So far, what we've seen seems to be limited to the banks we're talking about and some of the regional banks.